The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled Rules Without Analysis, Federal Banking Proposals under the Biden Administration. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. An onslaught of significant regulatory proposals has been put forward, driven by Democrat-appointed regulatory officials who have unfortunately injected politics into what used to be an independent rulemaking process. Although Congress has repeatedly asked, we have not seen any analysis of why the existing bank capital framework needs to be overhauled or how the numerous regulatory proposals over the past year will work together or not. Rules without analysis lead to bad policy outcomes and invite mistakes that will later be called unintended consequences. The failure to properly analyze proposed rules and follow administrative procedures represents an abdication of responsibility on the part of those who have made numerous significant but underanalyzed new regulatory proposals. The most glaring example of this flawed approach to regulation is the major, significant, unmotivated, and underanalyzed Basel III Endgame. This proposal involves trillions of dollars in resource allocations and will increase regulatory costs for about $22 trillion in assets, or 80% of all U.S. banking assets. Despite this substantial impact on our economy, the needed analysis seems to be an afterthought, and far too many elements of the proposal are arbitrary and capricious. Only recently have federal bank regulators gathered data that they should have been obtaining before they even proposed the rule. Only very recently have Congress and the American people been told that the regulators will do a quantitative impact study, which may be available after the Basel III Endgame proposals comment period has ended. Whether comments will be accepted, and if so, the timing of the comment period on this quantitative impact study has not been made clear. Members of Congress from both chambers and both sides of the aisle have expressed significant concerns about the effects of the Basel III Endgame proposal, reflecting the lack of analysis that has been performed to this very day. Comments on the Basel III Endgame submitted by a wide range of interests and from across the ideological spectrum also have expressed far-reaching and widespread concerns. Most comments express the same concerns we've heard in our committee and in this subcommittee since the proposal was first put forward. The banking system is well capitalized and resilient in stress tests, leading to the question of why Democrat-appointed regulators want to massively ramp up capital requirements and go far beyond what Basel recommends and our competitors are adopting. The proposal has virtually nothing to do with the March 2023 banking turmoil, even though Democrat-appointed regulators have unsuccessfully tried to use the March turmoil to justify massive changes to the already gold-plated U.S. capital framework. The Basel III Endgame proposal will reduce credit availability and increase costs for consumers, homebuyers, businesses large and small, manufacturers, municipalities, farmers and ranchers, and more. The proposal will make U.S. institutions less competitive globally and will chase activities outside of the regulatory perimeter for banks, posing threats to financial stability, the functioning of our capital markets, and the abilities to hedge risk. The bottom line is that the Basel III Endgame proposal contains fatal flaws across the board, and we know nothing about how it would holistically interact with the numerous other significant recent and prospective regulatory proposals. These proposals include, but are not limited to, long-term debt requirements, the Community Reinvestment Act, resolution planning requirements, debit card interchange, or regulation II, and whatever may be forthcoming regarding liquidity requirements and stress testing. My message to the boards at the Fed and the FDIC is that merely recalibrating treatments of mortgages and green energy tax credits in the proposal and reducing the punitive and unjustified operational risk penalties in the proposal will not resolve our concerns or fix the remaining significant problem areas in the proposal. There are far too many other fatal flaws that need to be addressed, including treatments of market risk, exposures to companies with public listings versus non-public listing, abandonment of internal models, effective repeal by regulation of the tailoring law, and the interplay with stress tests. The federal banking regulators should scrap their faulty Basel III Endgame proposal and reevaluate what, if anything, may need to be done. At most, the regulators need to start over, undertake proper analysis, follow proper administrative procedures, and repropose a significantly different rule. As things stand for the onslaught of regulatory proposals, the regulators must provide proper quantitative analysis, follow the Administrative Procedure Act, and stop using our regulatory system to push a political agenda. After all, these agencies are meant to be independent, and if they continue to act in a way that threatens this, Congress will act. Our regulators can and must start over and do better. There is too much at stake. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chairman Barr, and thank you to our witnesses for being here today. Recent proposals from federal banking regulators on the Basel III Endgame, long-term debt, and the GSIB surcharge aim to bolster the safety and soundness of our banking system by ensuring that U.S. banks properly manage and internalize the risk they take on. When I first joined Congress in March of 2008, we were on the edge of a financial crisis. Excessive leverage and risk-taking by large U.S. banks and non-banks put the global economy on the brink of collapse. The result of this crisis was a federal bailout that the MIT Sloan School estimated ultimately cost U.S. taxpayers nearly $500 billion. While significant steps have been taken since 2008, including the passage of the Dodd-Frank Act and the implementation of new capital rules, the financial landscape is constantly changing. Rapidly developing financial technologies, growing geopolitical tensions, and climate change present new risks, and we must be vigilant. Today's conversation will focus on the calibration of new regulations proposed by prudential regulators. Simply put, there are costs and there are benefits associated with raising the capital requirements on large banks. Well-capitalized banks are better able to weather stress and continue lending during an economic downturn without putting taxpayers at risk of funding another bailout. On the other hand, higher capital requirements can increase the cost of capital for these large banks, which will, to some extent, increase the cost of loans and potentially create economic incentives for whose impacts may be difficult to predict. You know, in this whole discussion, there's a part of it that you can calculate and a part of it that you can probably not calculate. For example, Vice Chair Barr has opined that the cost of capital for the large banks will be increased by about 3 basis points, 0.03%. Others have estimates that may be 2 times higher, but it's a small fraction of a percent. And so that is the part you can calculate. The part that's difficult to calculate is how that will trickle through the rest of the economy. What fraction of that increase in the cost of capital will be simply result in a transferring of business away from large banks to smaller banks or to non-banks, and what the implications of the systemic risk to our banking system will be of that sort of transfer. Banks will try to optimize their capital deployment in a different way as we change these rules, and so they will move their business from one area to another. This is the part that's difficult to calculate and was hopefully captured in the data that's being collected by the regulators as they look at the final update of this rule. But you know, I remember during the lead up to Dodd-Frank, as we were writing it, the banking sector argued that all these new requirements would make the U.S. banks unprofitable and uncompetitive in comparison to other banks, and we've heard that effectively the capital levels have been higher for U.S. large banks than they have for European and other competitors. However, since then, U.S. banks have continued to earn record profits and increase their market share around the world. And so I'd be interested in the committee's, the witnesses' take on, you know, why on this previous, all of these previous crying wolf on high capital requirements has, you know, from a sort of empirical sense, proven so wrong. But for me, the key issue is not the straightforward effect, but it's the knock-on effects, and those are difficult to predict. I've become a great believer in unintended consequences of regulation, and so this is the area that I've been mainly focusing on, trying to understand how banks will change their business in response to these changes in capital requirements, and that's what I will be continue to be focusing my attention on there. And I'm done, and I yield back.
Thank you. The gentleman yields back. And today we welcome the testimony of Mr. Greg Baer. Mr. Baer is the president and CEO of the Bank Policy Institute. Mr. Brian Basher. Mr. Basher is the director of financial policy for the Americans for Tax Reform. Mr. Randall Gwynn. Mr. Gwynn is the chair of financial institutions at Davis Polk. And Professor Jeremy Kress. Mr. Kress is assistant professor of business law at the Stephen M. Ross School of Business at the University of Michigan. We thank each of you, congratulations on the national championship. we thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Baer, you are now recognized for 5 minutes for your oral remarks.
Thanks. Chairman Barr, Ranking Member Foster, members of the subcommittee, thanks for the chance to be here today. If adopted, the capital rule proposed by the federal banking agencies would have a profound effect on the cost of credit for nearly every American business and consumer, as well as on the resilience of U.S. capital markets. Given those stakes, the proposal is remarkable for its lack of analytical rigor and its aversion to the use of relevant data. In almost every case, the proposed risk weight for a given asset is based on no historical experience, even where voluminous data is available. In most cases, the proposal simply adopts the risk weights negotiated by agency staff in Basel over 6 years ago, and then adds arbitrary surcharges. Finally, the proposal fails completely to acknowledge that in the U.S. and the U.S. alone, a stress capital charge for most of the same risks is already imposed by the Fed. These failings violate both the procedural and substantive requirements of administrative law. For credit risk, the agencies propose to eliminate the advanced approach that employs more granular and adaptable bank models, even though retention of those models was the core of the 2017 agreement, and they have by all accounts produced accurate results for well over a decade, overseen by these same agencies. The proposal then adds a massive new charge for operational risk, which we estimate would add up to a capital requirement that is 3.5 times larger than the largest losses experienced by U.S. banks in any year since 2003. By our estimate, the total capital increase would be significantly more than the 16% estimated by the agencies. For the largest, most diversified banks, it would be around 30%. The increase from market risk would be an astonishing 75%. So as a bottom line, the proposal effectively finds that U.S. banks are currently critically undercapitalized, something that no one in the real world believes for a single moment. Some examples are telling. For business loans, documented historical experience suggests that a risk weight of 41% would be sufficient, 30% for loans rated investment grades. Instead, the proposal establishes a requirement of 100% and 65% only for firms rated investment grade and that have listed securities. So 2 to 3 times what the data suggests is necessary, and without explanation. With regard to market risk, the proposal ignores completely its overlap with the Federal stress test, which covers the same risks for the same reasons. Again, there is nothing about the real-world performance of U.S. banks to suggest that their trading operations are critically undercapitalized, and the proposed rule actually makes no attempt to do so. And of course, in combination with a variety of other pending rules, the Basel proposal would effectively repeal the tailoring law passed by Congress. Now, some who have no desire to engage the details of the proposal have argued that it is good because it simply means higher capital, and higher capital is always good because well-capitalized banks lend more in crisis than undercapitalized banks. Of course they do. But they also don't re-enter businesses that they abandoned years earlier because of high capital requirements. Furthermore, what the research actually shows is that they lend more only if their high capital exceeds regulatory minimums, so that they feel free to draw down on that capital. If the minimums rise, as they sure would here, that will not happen. By the same token, SUVs with 50 airbags are safer in a crash than those with 4, so why not mandate 50? Because such cars would be very expensive, fuel efficient, and no one would build them ex ante. So the real question is whether large U.S. banks are already sufficiently well capitalized to continue lending under stress. We know they are, as demonstrated by consistent post-crisis experience, including the pandemic and SVB, and through performance under the Fed stress test, which has that as its explicit purpose. To minimize the effect of the proposal, as the ranking member notes, the Fed's vice chair has argued that the proposal would on average raise the cost of loans by only 3 basis points. As our economists, I think, first documented and is now not disputed, that estimate omitted over $1 trillion in operational risk-weighted assets that at least a majority of which are attributable to lending. More importantly, that 3 basis points is only an average. For some assets, for example, commercial real estate, lending to large listed companies, the number would actually go down. For others, it would go up. We estimate for credit cards, the number is 50 basis points, or $250 per year in interest on a $5,000 balance. Of course, banks will shift their business away from the assets that receive the higher risk weights. And I should note, all of this is occurring in a world where banks, many U.S. banks, are trading at or below tangible book value, despite earning profits, but markets don't look at profits, they look at return on equity, where banks are at historical lows in the United States, and where their performance has trailed just about every industry. So in light of all that, we urge the agencies to withdraw the proposal, draft a new one, show their work, and seek public comment.
Thank you. Mr. Basher, you're now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the invitation to testify today. My name is Brian Basher, and I am the Director of Financial Policy at Americans for Tax Reform. ATR is a nonprofit 501c4 taxpayer advocacy organization that opposes all tax increases and supports limited government free market policies. In support of these goals, ATR opposes heavy regulation and taxation of financial services. ATR was founded in 1985 at the request of President Ronald Reagan. I'm here today to talk about the proposed bank capital rule, which is based off the Basel Committee on Banking Supervision's Basel III Endgame Framework. In November, the subcommittee discussed how the Basel Committee, among other international organizations, has directly influenced U.S. banking regulation. Now, the discussion will specifically revolve around a proposal that circumvents congressional intent, abuses regulators' discretion, and is arbitrary and capricious. The Federal Reserve, Federal Deposit Insurance Corporation, Office of the Comptroller of the Currency are proposing to heighten regulations on banks with at least $100 billion in consolidated assets. The proposal would force large banks to build up more capital through retained earnings and additional stock issuances without any input from Congress. These new rules will make borrowing more expensive, hamper dividends and share repurchases, and reduce the availability of credit cards and mortgage loans. Activities and services the government should not be micromanaging. Banks should remain private and not regulated to such an extent that they resemble heavily regulated utilities or other quasi-governmental entities. The Basel Committee's influence on banking regulation across the globe has created a regulatory structure that circumvents Congress. This is evidenced by the proposal's direct repudiation of the Bipartisan Economic Growth, Regulatory Relief, and Consumer Protection Act. Congress passed this legislation with the intent to tailor regulation for bank holding companies. The proposal eliminates and replaces the tailored regulation from S-2155 by applying uniform regulations to all banks with more than $100 billion in assets. For example, the proposal expands the inclusion of accumulated other comprehensive income for available for sale securities to capital calculations for Category 3 and 4 banks. Category 3 and 4 banks would also be required to calculate their capital based on both the new expanded risk-based approach and the existing standardized approach, and then measure the compliance based on the more stringent of the two ratios. The supplementary leverage ratio and the countercyclical capital buffer would also be expanded to apply to Category 4 banks. The proposal also largely eliminates the use of banks' internal models without any empirical analysis justifying this prohibition. The blanket application of these requirements defeats the purpose of S-2155. This proposal is arbitrary and capricious, an abuse of discretion, and exceeds the statutory bounds with which the regulators are supposed to operate. Regulators may not expand their authority merely because they believe their preferred approach would be better policy. The regulators have claimed to have broad statutory authority to amend capital requirements at will. However, Congress does not alter the fundamental details of a regulatory scheme in vague terms or ancillary provisions. It does not, one might say, hide elephants in mouse holes. Congress made it clear in S-2155 that there needs to be a regulatory structure that is best tailored to banks with different services and operations. The proposal dismisses Congress's intent and moves ahead anyway. Regulators are justifying the uniform application of capital requirements to banks in categories 1 through 4 by referring to recent events or the collapses of Silicon Valley Bank, Signature Bank, and First Republic Bank. However, these banks' failures cannot and should not be attributed to all U.S. banks with more than $100 billion in assets. The capital requirements dictated by the regulators have not been condoned by Congress and are arbitrary and capricious under the Administrative Procedure Act. The proposal is a classic example of the government intervening in the operations of private companies by mandating how they must organize their balance sheets. If finalized, the proposal has the potential to reduce the availability or increase the cost of credit for auto loans, credit cards, small business loans, and mortgages. One paper describes how the regulator's unbridled quest for more stringent capital requirements can make capital allocation more expensive. According to the paper, all else equal, making regulated banks less risky may actually raise their cost of capital, with consequent implications for investment and growth. At the end of the day, major questions and policy decisions need to be left to Congress. Unelected bureaucrats should not be in the business of creating the law. Thank you again for inviting me to this hearing. I look forward to answering your questions.
Thank you. Mr. Gwynn, you're now recognized for 5 minutes.
Thank you. Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for inviting me to speak today. Starting last July, the U.S. banking agencies issued a series of proposed regulations that would significantly increase the going concern capital of the largest U.S. banks. Like an excise tax, this will increase the cost and decrease the supply of credit to businesses and families. The agencies would also impose a new gone concern capital requirement on large regional banks in the form of long-term debt that is subordinate to all runnable liabilities. Let me highlight a few points about this. First, if you combine the going concern and the gone concern capital requirements, those two proposals would fall most heavily on the regional banks. They would nearly double the current capital requirements of those banks. This would substantially eliminate tailoring between the GSIBs and the regional banks, giving the regional banks a powerful incentive to grow larger to remain competitive. Second, the Basel III Endgame proposal would increase the required capital for market risk by 77%. This will increase the cost and reduce the supply of market making. Markets will become less liquid. It will become more expensive for businesses and local governments to raise debt and equity capital. It will make it more expensive for manufacturers, farmers, and others to hedge their risks. Third, the Basel III Endgame would subject U.S. banks to significantly higher capital requirements than banks in the UK, Europe, and Asia. Virtually every other country has implemented the international framework in a capital-neutral way, but the U.S. proposal would not. In particular, the international framework imposes an output floor equal to 72.5% of the standardized approach for credit risk, but the U.S. would impose a floor of 100%. Even if the U.S. proposal were capital neutral, U.S. banks would be subject to higher capital requirements than their foreign competitors. That's because the Fed uses stress testing to set capital requirements. Foreign banks are subject only to a capital conservation buffer of 2.5%, whereas most large U.S. banks are subject to a stress capital buffer that is higher than 2.5% and never lower. Fourth, by imposing a new capital tax on credit risk, the proposal will increase the cost and reduce the supply of credit. This will result in more and more credit being supplied to the economy by non-bank financial institutions where there is less visibility, less liquidity, and less capital. In an integrated financial system, that creates more stability risk even for banks. The market share of non-bank financial institutions has doubled since 1980 from 30% to nearly 60% of all credit supplied in the U.S. economy, and the Basel III Endgame proposal would encourage this trend. Fifth, I can't recall another rule that would have such a big effect on the U.S. economy with so little supporting data. Although the regulators said they performed a holistic review of capital requirements, they didn't release any data from that review, and certainly no rigorous cost-benefit analysis. Finally, the opposition to the U.S. proposal is unprecedented. I can't recall another proposal that received so many dissents from agency principals or so many negative comments from such a diverse cross-section of the public and by members of Congress on both sides of the aisle. I'm happy to answer any questions that members of the subcommittee may have.
Thank you, Mr. Gwynn. Professor Kress, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, members of the subcommittee, thank you for inviting me to testify at today's hearing. By way of background, I'm an assistant professor of business law at the University of Michigan's Stephen M. Ross School of Business and co-faculty director of the University of Michigan Center on Finance, Law, and Policy. My research focuses on bank regulation, systemic risk, and financial stability. Prior to entering academia, I was an attorney at the Federal Reserve Board, where, among other things, I worked on the initial implementation of the Basel III capital rules. The federal banking agencies have recently proposed several rules that would increase capital levels for the United States' largest banks. Taken together, these rules will better calibrate large banks' capital requirements to the risks these banks pose to society and reduce the likelihood of financial crises that could devastate the economy. Regrettably, the banking sector has responded to these proposals by spreading misinformation in an effort to delay and defeat them. I will make 3 points in my testimony today. First, higher capital is essential to making the U.S. banking system safer and more efficient. Over the past 15 years, policymakers have repeatedly provided public backstops to banks, either directly or indirectly, through Federal Reserve lending facilities, fiscal support measures, and equity injections. Stronger capital requirements will help counter the poor incentives these rescues have fostered and reduce the need for such extraordinary interventions in the future. Ensuring that large banks maintain sufficient capital is especially critical in light of questions that have arisen about authorities' ability to resolve systemic banking organizations following the disorderly collapse of Credit Suisse and 3 U.S. domestic systemically important banks last year. Second, stronger bank capital levels will promote credit availability throughout the economic cycle. Better capitalized banks lend more during economic and financial stress, precisely when households and businesses need credit the most. Recent U.S. experience confirms that higher capital is consistent with sustained credit creation and economic expansion. Indeed, the Dodd-Frank Act and initial Basel III rules raised bank capital requirements during what became the longest U.S. expansion on record, exposing as false banks' contemporaneous warnings about the potential dire consequences of increased capital. The pending Basel III Endgame rules will foster, not threaten, credit availability, as most of the proposed capital increase is associated with large banks' trading and fee-generating businesses, not their lending activities, and the risk weights for many categories of traditional loans will actually decrease under the proposal. Third, the banking sector is trying to invent new legal standards in a brazen attempt to defeat these rules. Requiring banks to fund themselves with more equity will not impair credit availability, but it will modestly reduce bank stock prices, share buybacks, and executive compensation. To avoid this outcome, large banks are attempting to hold their regulators to legal standards that simply do not exist. Congress has subjected rulemaking by some agencies, including the Securities and Exchange Commission, to various forms of cost-benefit analysis. However, Congress has not imposed any cost-benefit requirement on the federal banking agencies. And for good reason. Quantifying the benefits of a banking crisis averted is a nearly impossible task. The law that does govern rulemaking by the federal banking agencies, the Administrative Procedure Act, requires only reasoned decision-making, a standard the current proposals assuredly meet. Indeed, the level of analysis in the current proposals is at least equal to, and in many cases exceeds, prior federal banking agency rules. Make no mistake, if the current proposals are legally deficient, so too are the vast majority of the deregulatory rules adopted under the Trump administration with far less reasoned analysis. In sum, the current proposals will strengthen large banks' capital cushions, reduce the likelihood of future financial crises, and position large banks to remain a source of credit to households and businesses throughout the economic cycle. The banking agencies should finalize these proposals without delay and without materially weakening their provisions. Thank you, and I look forward to your questions.
We'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. I just failed to, at the outset, understand the logic of this idea that in order to protect the economy and financial stability, we have to destroy the economy. That doesn't make sense to me. I note with interest that many of my colleagues on the other side of the aisle and stakeholders from across the ideological spectrum have expressed significant concerns with many aspects of the Basel III Endgame. There's a reason why there's bipartisan concern. Because on a bipartisan basis, we don't believe, Congress does not believe, that the way to protect the economy is to destroy the economy. Many comments on the proposal relate to treatment of mortgages or green energy tax credits. Both issues are examples of unintended consequences from a proposal that contains shockingly deficient analysis. Yet, concerns and comments have been expressed from a wide variety of stakeholders covering far more issues than just mortgages and tax credits, including issues concerning market risk, abandonment of internal models, and more. The bottom line for commenters is concern about the unknown and unestimated negative effects on credit availability and costs from the proposal from homebuyers, consumers, manufacturers, disadvantaged communities, municipalities, and businesses, large and small. Mr. Baer, can you touch on the treatment of market risk in the Basel III proposal and talk about likely impacts?
Thank you, Congressman. Mr. Chairman, I mean, market risk is a very complicated subject. It's very difficult to measure, but it can and is measured in the proposal. The problem is it's covered twice. After the financial crisis, there was a realization that value at risk models, which cover problems that happen most of the time, but not all of the time, was not a sufficient measure, and you needed to actually look into the tail of risk and cover the worst case. The U.S. did that, the Federal Reserve, through the global market shock, and basically had stresses worse than the global financial crisis. The rest of the world did not adopt a stress test like the Fed. Instead, it went off and worked on a market risk add-on or supplement to Basel, which it called, oddly, the Fundamental Review of the Trading Book. That did effectively the same thing as the global market shock. And now everywhere else in the world, they are going to adopt the Fundamental Review of the Trading Book as the measure for market risk, for market risk. And only in the U.S. are we apparently on a path to adopting both and doing a pure double count. I should say there are some other issues within the Fundamental Review of the Trading Book. There are some assumptions that don't make a whole lot of sense. There's an expected shortfall method that really disqualifies the use of models in a lot of cases where they ought to be used. There's something called, things that can't be modeled, and you then get a punitive stress test or standardized charge. So there are problems within the Basel proposal, but the largest problem is the overlap.
Yeah, this double counting, I think, is really at the core of why this proposal would make our economic system less competitive internationally. Mr. Baer, can you quickly also discuss the proposed abandonment of internal models and whether in doing so, financial institutions' risk profiles and portfolios will be homogenized and thereby actually threaten financial stability?
Sure, it's an excellent point. I mean, in the U.S. for the largest banks, we are currently using what's called the advanced approach, is well named, whereby granular bank models are used as opposed to just lumping together classes of loans that don't have a lot in common, which is what standardized approaches do. That system's been operating since 2011 under extraordinarily stringent guidance from the agencies, and they have at no point between then and now raised any concerns about the accuracy. There's never been an action against a bank. More importantly, when it adopted its standardized approach, it assumed that standardized approach would effectively apply at 72.5% of where it landed, because banks would be able to use internal models. Only in the U.S. are they proposing to eliminate the use of models and effectively set the standardized charge at 100%. That will certainly herd banks, as you know, into asset classes that are favored by the standardized approach.
Mr. Gwynn, real quick, Vice Chair Barr has argued that the effects of this onerous proposal are modest, amounting to increased average loan costs of just a few basis points. Can you discuss whether you believe that there would be a more substantial impact of this proposal?
So I do think that other economists have looked at this and suggested that there's going to be a much bigger impact. Certainly, the biggest impact is operational risk, but operational risk will affect the cost of loans as well. And the market risk, although it's not directed at lending, it is directed at raising debt and equity capital in the capital markets, and it will increase the cost there.
Mr. Gwynn, how important is it for the Fed to provide the public and regulated institutions with sufficient time to comment on the rule's quantitative impact study?
So I think that's incredibly important. I think one of the surprises here is that they didn't do the quantitative impact study at the same time they released the rule, but I think people need 60 to 90 days, I think, to actually absorb it and comment on it appropriately.
My time has expired, but again, I mean, it is possible to prevent disease by killing the patient, but I don't think we should kill the patient. With that, I yield and recognize the ranking member for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. So this is your chance to go on the record with a prediction. Which of you, I will go down the line here, would predict that if this proposal goes ahead as essentially as proposed, that large U.S. banks will no longer be competitive and no longer be increasing their market share? So we'll just start. Are you predicting that if we go ahead and adopt rules that will require slightly higher capital requirements for large U.S. banks, that they will become uncompetitive and lose market share?
Ranking Member Foster, I think that will be line of business by line of business. We've seen them losing market share for some time now in mortgage, lending.
In the whole, all right, in the whole, do you expect, because we had these predictions as we were writing Dodd-Frank, that if we went ahead like this, that they would be crushed by offshore competitors. That has not happened. Are you predicting it will happen if this goes ahead now? In the whole, will the aggregate effect make U.S. banks lose market share?
Yes. If
So
it
you
goes
predict
into
they will
effect as
decline.
proposed.
Okay, next.
Certainly, capital
Yeah,
markets.
Mr. Basher, next.
Across the board.
I think it would definitely put a lot of strain on them.
No, will they become uncompetitive compared to offshore banks? That's the question, which are held to lower capital requirements.
I think that the strain over time could make them much more uncompetitive.
But you're not predicting it will. Okay, next.
I think their costs will go up relative to the foreign competitors, but there are a lot
That's
of fac-
different than, no, but that's a double-edged sword.
there
Will
are-
the net effect
But there
make
are a
them
lot of
uncompetitive?
factors that affect whether you're competitive or not, and I think that they will continue to be competitive, but they will face higher costs because of this capital proposal.
Yes.
Capital makes us strong. U.S. banks will continue outperforming their international competitors, just as they did after the Dodd-Frank Act in 2010, despite complaints about gold plating that we heard from the banking sector.
Yeah. No, another issue that gets brought up a lot is this issue of double counting with this, that the stress test already counts them. But the choice of the stress conditions is a tough one. I mean, if you could take very realistic near-term stress conditions, will banks remain well capitalized? For example, if China invades Taiwan, the supply of integrated circuits is shut down to the world. There's a worldwide blockade on China. Every business in the United States relies on importing Chinese goods, marking them up. They will find supply chain, they're shut down. How many banks will fail under that circumstance? Is that a realistic test? It's my impression that the stress tests don't even come close to that level of stress, and yet it is a quite plausible geopolitical possibility, unfortunately. So what is your, when you talk about double counting, in a situation where you haven't actually stressed the banks as much as they plausibly could by worst case geopolitical events, how do you think about that?
Sure. Both the FRTB under Basel and the Fed's GMS, Global Market Shock, are agnostic as to the cause of the stress. Basically, they look at how much our spread's going to blow out across all types of securities, and then how much illiquidity is there going to be. That is, for how long will the institution be unable to sell that security. Now, that could be because of war, pestilence, you name it. Both of them are pretty calibrated around the worst moments of the global financial crisis, and then some. And I think it's a reasonable assumption that if there were the upsets of the type that you saw, it's difficult to imagine a worse upset than we saw in 2009. And it's also difficult to imagine that you want to capitalize market making for U.S. capital markets on that assumption. At that point, perhaps there's a role for the government, but it's certainly not a reason to capitalize the banks every day for a scenario significantly worse than the worst moments of 2009, and then do it twice.
Okay. Yeah.
Thank you, Ranking Member Foster. I think 2 points. One, the banking crisis of last year demonstrated that we absolutely need more variability in our stress test scenarios. The Federal Reserve had not stress tested against a rising interest rate environment. We saw what happened. So looking at implementing more variety in the scenarios, it's definitely something the Federal Reserve should do. Second, on the issue of double counting, I just want to emphasize that minimum capital requirements and the stress test do different things. Minimum capital requirements are calibrated to ensure that banks remain solvent, that their assets exceed their liabilities. The stress test, on the other hand, is designed to ensure that banks remain above their minimums even during times of stress, because we know when banks approach their minimums or go below their minimums, that's when they pull back on lending. So I don't think it's fair to characterize it as double counting, because the mechanisms are supposed to do different things.
Thank you. My time is up, and yield back.
The gentleman from Florida, Mr. Posey, is now recognized.
Thank you, Mr. Chairman, and I thank the witness for appearing here today. Mr. Baer, Mr. Basher, Mr. Gwynn, and in early December, J.P. Morgan CEO Jamie Dimon told the Senate Banking Committee that under the new capital rules, Mortgages and small business loans will be more expensive. Saving for retirement or college will be harder. Consumer prices will rise, and the government infrastructure projects and corporate development will become more expensive. What does your research and experience suggest?
Sure. Let me just give mortgage as an example. I think the others are similar. Again, if you assume 100% risk weight, that basically means $100 loan, $8 of capital. If you assume 8's about the average. So under the current rules, the risk weight for mortgages is 50%, so $4. Under the advanced approaches being used by the largest banks, which are a more accurate gauge, it's 25%. Under Basel as proposed and agreed to in 2017, and for the rest of the world, the risk weight's 25%. Under the US proposal for LTVs between 80 and 90%, so good, solid, highly collateralized loans, it's 95% if you include the stress capital buffer from the Fed. And for its loans sold to the GSE, it's 150%. So we're talking 3, 4, 5 times current rates under the advanced approaches and what's been agreed to at Basel. And again, back to a theme here, there is no analysis in that proposal to demonstrate why those levels of capital are necessary, no historical losses to justify that outcome.
Incredible.
So the two, Greg focused on mortgages. Let me focus on small and medium-sized enterprises and infrastructure. So the principal provision that affects the small businesses is one that basically says you have 100% risk weight unless you actually are investment grade and you have publicly listed securities, in which case it's a 65% risk weight. So that means that the lending to the bank, the company that has listed securities will be cheaper than what it is to the SME. Most SMEs do not have listed securities, so they can't qualify for the 65% risk weight. They will be borrowing at the 100% risk weight. For infrastructure, the cause there of the increased cost is the extremely high increase in capital requirements for market risk, which are set, an increase of 77% according to the agency's own estimate. That will substantially increase the cost and reduce the supply of market making. That makes markets less liquid. That makes it more expensive for local or even the federal government to finance its infrastructures because they'll have to pay more of a risk premium when they borrow money to do those. And also it'll be harder to hedge the risks of those.
Thank you. Mr. Basher?
I'm very concerned about credit cards and the expansion of the supplementary leverage ratio because credit cards will be considered an off-balance sheet exposure that would be in the denominator of the SLR. So now all of a sudden that's going to impact Category 4 banks and their availability to issue new credit. And then also the effect on retirees that are invested in collective investment trusts. I think that the market risk capital requirements are going to significantly hamper liquidity there. And then on top of that, if we're talking about double counting, I think just inherent in the proposal itself, the application of the operational risk charges to every facet of every service that these banks offers is questionable.
Thank you. When Silicon Valley Bank failed, Secretary Yellen kept repeating over and over and over that the banking system is well capitalized, which made me wonder about the need for Basel III. Mr. Kress, was she telling the truth?
Congressman, I think there's a difference between the legal definition of well capitalized, 10% equity, versus the normative question
Was she telling the truth?
Legally, the banking system is well capitalized.
Okay.
But that doesn't answer the
That's
question
good.
of
I'm
whether
running-
it is well capitalized
I'm running out
enough for us to be comfortable with the activities that the banking sector is engaging in today.
I'd like to hear from the other gentleman. You agree?
Yes, I don't think she was mincing words.
I agree.
So none of the agencies have put forward any evidence to say that it's not sufficiently capitalized. And if you look at the recent history, the banks have been a source of strength during COVID-19 and other things. And so there does seem to be plenty of evidence that they are well capitalized.
Thank you. My time has expired, Mr. Chairman. I yield back. Thank you.
Gentleman yields. The gentleman from California, Mr. Sherman, is recognized.
Nothing is free. If we have maximum capital standards, we reduce economic growth and hurt small business and first-time home buyers. If we minimize the capital requirements, then we increase economic risk. And we saw in 2008 how first our economy was shook to the core, and then with the bailout, our constitutional system and social contract was shook to the core. But what I think we can agree on is that poorly tailored regulations are bad. They reduce economic growth without reducing the bailout risk. And I commend the regulators for trying to strengthen our banking system, but there are some poorly tailored regulations. One example that I'll get to later is giving no credit for private mortgage insurance and thereby hurting first-time home buyers and people of color disproportionately. These regulations are being sold as we're going to harmonize with Europe. It's Basel. It's something the whole world is doing, when in fact these regulations go far beyond Basel in most cases. This is not harmony with Europe. This is an attempt to move toward higher standards than Europe has. There is certainly one area that I see where these regulations are inadequate, which might put me to the left of Mr. Kess, and that is on interest rate risk. Before 2019, banks with over $250 million, I believe, had to recognize unrealized losses on available for sale securities. That's what the bill I've introduced, the Bank Safety Act, would require for all banks over $100 billion. But what about the held to maturity securities? Silicon Valley Bank proved to us that you can bankrupt a bank by investing in long-term debt, and it doesn't matter which category you put it in, held to maturity or available for sale. If you buy enough of them, you can not just have a liquidity problem, you can have a solvency problem. Your bank can be bankrupt, and these regulations inadequately deal with that. When it comes to stress testing, I've proposed the Effective Bank Regulation Act to say that the bank stress testing should look at interest rates going down as one of the possible stresses. The response from bank regulators sitting right there was no. Interest rates going down only helps banks because we have the stupid depositor profit center. Depositors will leave their money in. They don't. Silicon Valley Bank went under. Mortgage servicing rights are hurt by these proposals, and that is going to hurt home borrowers, and especially those on the first-time home buyers. We have, I'm concerned about the effect this will have on our capital markets. At a time when we pass the Bipartisan Infrastructure Act, this is going to hurt municipal bonds and make it harder for do the very projects that we united to be in favor of. As I mentioned, you give no credit for private mortgage insurance, and I want to thank Representatives Meeks and Beatty and Vargas and Horsford and others for joining me in sending a letter saying they need to reconsider that. As Mr. Gwynn put it out, this regulation advantages the big borrowers with listed securities and penalizes banks for doing the one damn thing we want them to do, and that's to lend to local businesses, particularly on Ventura Boulevard. But I can't imagine why they did that. And then finally, as to the clean energy tax credits, this gives them a zero value while preserving a value for the very analogous low-income housing credits. So we have a regulation that does nothing to learn from the Silicon Valley Bank, and it encourages banks, if they want to make a profit, to engage in risky, perhaps profitable, but risky bets on long-term, non-interest rate adjustable bonds without an interest rate hedge. And then it hurts first-time home buyers, small businesses, and the environment. Can I sneak in a question?
The gentleman's time has expired. The gentleman from Missouri, Mr. Luchtenmeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and I certainly appreciate and want to associate myself with the remarks of Mr. Sherman. He nailed one point after another that is problematic with this rule. He articulated not only the problem, but the effect that it could have on our small businesses in particular and the different markets he was talking about. I applaud him for his remarks this morning. As somebody who was a former regulator for a couple of years and in the banking business for another 40 plus, I appreciate higher capital. I believe in higher capital. I think it's important. It solves a lot of problems. But there is a limit, as Mr. Sherman just said, as to where that line should be. After Dodd-Frank, I'm not a big fan of Dodd-Frank, but it actually worked from the standpoint of having the banks have more capital. And I think the ultimate stress test was about 3 or 4 years ago when we had the pandemic. And we survived that. Our banking system survived that. Our economy survived that as a result of strong banks. And now we're trying to go out here and put more capital in the banks. We're trying to, in my mind, trying to appease the foreign folks, as Mr. Sherman articulated. We're going beyond what they really want us to do. And I think part of this is a result of the 3 banks that failed last spring. It wasn't that the banks were undercapitalized. They would have had to have 25 to 30% capital. They were underregulated. This rule, to me, tells me that the regulators aren't doing their job. And I told them when they were sitting in your chairs right there, this fiasco that happened last spring is 50% your fault because you allowed a business model to exist, go unchecked. You knew it was wrong, your reports show it was wrong, and yet you did nothing. This rule is a way for them to cover their rear ends, it looks like to me. So I asked myself the question, what problem are we trying to solve here? Mr. Baer, can you give me an answer to that question? What problem is this rule trying to solve?
Well, I'll try to be kind. Which is
You don't have to be, that's all right.
No, I think the genesis of this is that in 2017, agency staff agreed to Basel, and now they're getting around belatedly to implementing it. And there are good arguments for having international standards and some similarities among capital requirements. But what I find what's so perplexing and concerning about this proposal is that's not really what they've done. They've added in almost every case to the Basel risk weights they agreed to. The securities listing requirement that Randy talked about that disqualifies small businesses from access even to a 65% risk weight when the numbers show it should be 30 to 40. Well, that was jettisoned by both the European Union and the UK. And of course, here we have the stress test that they don't have. So I understand the spirit, let's get Basel done, but this isn't Basel.
Mr. Basher, if you would answer that question as well, but considering this fact, I was in a Small Business Committee hearing, I'm Vice Chairman of the Small Business Committee, and the other day we had a very, very respected economist there, and he said that this administration proposes about $150 billion a year in new rules and regulations, costs that have to be assimilated into the budgets and the services and products that are sold by these businesses, especially small businesses. This is a huge barrier for them, a huge burden for them. And there's no Administrative Procedures Act requirement here, supposedly, that forces them to do an economic study. How difficult is this to really be able to implement this, and should this be part of an economic study that, with regards, or should be a requirement of Administrative Procedures Act?
I think that this rule lacks a substantive economic analysis that needs to be observed, analyzed much more substantively. And I think that the effect on small businesses will be substantial. In fact, when I talked about credit cards earlier, I think there could be an effect on actual spending, which could impact small businesses. But in general, I think that with this proposal, and does this solve anything? This is a perfunctory measure. They're trying to follow through with what Basel has proposed, and I think that, but it's, again, that gets to the problem of why are we listening to Basel and not to you all. I do admit that there are certain places in statute where Congress has said let's do a capital requirement. There's one for 50% for certain residential mortgages, but as a whole, that's not the case. And I still think that because of the uniform application of these rules across categories 1 through 4 banks, that's in direct contravention to S 2155.
Thank you. I see my time has expired. I'll yield back, Mr. Chair.
Gentleman's time has expired. Gentleman from Georgia, Mr. Scott, is recognized.
Thank you very much. Professor Kress, I have expressed my deep frustration with this situation in our previous meeting on Basel III, and it seems like the Fed is being pulled in two directions. On the one hand, protecting the soundness of our banking system. On the other hand, preserving the ability for millions of borrowers to buy a home. That's the situation we're in. In your testimony, you highlight, it seems to me, an openness by regulators to make some adjustments in the proposal with respect to high loan to value residential mortgages. Tell me, have you seen any recent indication on this happening? And please excuse my cold.
Thank you, Congressman. I think this is a great example of the public notice and comment process working as intended. The agencies, following the Administrative Procedure Act, put the notice out for an initial 120-day period. They later extended that. The public has had now 173 days on which to comment. And they heard, as you noted, a lot of feedback on the residential mortgage front, and the agencies have indicated that they will take that into account. The initial proposal laid out 3 different options for how to address residential mortgages, and you know, it's too early to say what option they will use when they finalize.
And let me ask you this. If enacted, the provisions affecting mortgage lending in the Basel III Endgame proposal will require our nation's largest banks to hold significantly more capital against certain mortgage loans, like those of borrowers with less than 20% down payment. Does that trouble you?
Congressman, I think it's important to contextualize the businesses that these banks are in. Their proposal affects the 37 largest banks in the country out of 4,500. The depository institutions, the financial institutions that are providing loans to low and moderate income communities are primarily smaller community banks, credit unions, and in some cases, non-depository institutions. So I don't want to overstate the effect, because so much of the mortgage lending that you're concerned about is not being done by the 37 affected banking organizations.
And Mr. Baer, let me come to you. What would be the impact of risk weights for mortgage loans if they are compounded with the operational risk charge and the Federal Reserve's stress test?
Sure. I mean, obviously, the effect would be profound, as I gave some numbers earlier. I mean, you're talking about a capital charge probably 3, 4, maybe more times higher than historical loss experience would suggest, and that Basel agreed to. You know, you've already seen, you know, the market share of banks in mortgage decline precipitously over the last, 10 years. There was a little bit of an uptick last year, actually. But, I think you can expect that trend to continue. And, it's important not only because, banks tend to offer good loans, good prices, but also, they have much more of an incentive to work with borrowers who get into trouble. Actually, that's also punished in the proposal. If you do a workout, that's considered a default. So, in the nooks and crannies of this proposal, there are a lot of other provisions that hurt low and moderate.
And what about for mortgage loans intended to be sold to the government-sponsored enterprises?
Well, I mean, I think this was probably unintended, but it's a good example of how destructive the operational risk requirement is. You don't think of that as operational risk, but basically when a bank sells to the GSEs, they only hold it for 60, 90 days, but when they sell it, they get a fee. So that's not credit risk, but under the proposal, that's operational risk, because fee income is supposed to be a proxy for operational risk. And so there, you have a mammoth operational risk charge, which again results in 150% risk
Well,
for loans sold to the GSEs, which I assume they're going to fix.
Well, you see, I'm not the only one on this committee very frustrated with what's going on here. So tell me, why are they doing this?
Well, I mean, in general, again, I think it's Basel adherence, but again, with a lot of add-ons. The U.S. mortgage market, is, in particular with regard to the mortgage market's different. U.S. banks are much more dependent on fee income than foreign banks, and so I don't think that got a lot of attention in Basel. So U.S. banks are uniquely hit by the operational risk charges.
Thank you very much.
Gentleman's time has expired. The gentleman from Georgia and Vice Chair of the Subcommittee, Mr. Loudermilk, is now recognized.
Well, thank you, Mr. Chairman. Thank you all for attending this today. Very important conversation we're having, very timely as well. Before I get into my questions, though, I just want to reiterate something my colleagues have said before. The overhaul of banking regulations before us today isn't just about the globally, systemically important banks. The proposal will affect regional and mid-sized banks as well as their customers, but I don't think it's going to stop there either. During the limited public comment period, the regulators heard from Georgians on all sides of the political spectrum who are concerned about this proposal. I have a few of their comments right here. I'd love to read them all aloud, but we don't have time for that. So I'd like to insert all of those for the record.
Without.
Thank you, Mr. Chairman. Following the 2008 financial crisis, Georgia lost more small and community banks than any other state. After Dodd-Frank and the regulations that were imposed, since I've been in Congress, we were very slow to see de novo banks and community banks reinstated. In fact, when I first came onto this committee a few years ago, we still had 15 counties in Georgia that did not have a small or community-owned bank, and there were 2 that had no bank whatsoever. And a lot of that was because of the regulation. Now, I've got a whole suite of questions, but really, I think I can summarize this down what you've heard today on both sides of the aisle. There are a lot of problems with this regulation. So, Mr. Bear, I ask you first, would there be a downside to entirely withdraw this proposal and, given all the problems, to reintroduce it in a way that addresses a lot of the concerns that you've heard about here today?
Yeah, Congressman, I mean, I think that's completely appropriate and necessary in this case. You know, some of the changes that need to be made based on the data and the analysis were not even within the scope of the proposal. And we've talked a little bit about, the fact that the cost-benefit analysis, which is actually legally required, and I'll get to that in a sec, is going on through a belated QIS where we're never really going to get a chance to analyze what those costs and benefits are. That also seems to merit re-proposal. I'd note, in answer to Professor Kress, the Supreme Court's held, even though there's no explicit cost-benefit requirement in a statute, that doesn't mean that you consider the costs and benefits. In Michigan versus EPA in 2015, the Supreme Court actually ruled that in a statute that said that the regulation should be appropriate and necessary, that included a cost-benefit analysis. In fact, the court said, quote, agencies have long treated costs as a centrally relevant factor when deciding whether to regulate. Consideration of cost reflects the understanding that reasonable regulation ordinarily requires paying attention to the advantages and the disadvantages of agency decisions, end quote. So I think that's what's necessary here and really didn't happen the first go-round.
Okay, thank you. Mr. Gwynn, do you have thoughts on this? I mean, one of my concerns is seeing what happened post-2008, and a lot of that was because of capital requirements. I really don't want to see rural areas of Georgia go without local community banks, and basically those areas be taken over just by the big players. Same question to you. Would there be a downside to withdrawing the proposal entirely and then reissuing something that addresses these concerns?
So I think that could be a good, well, I actually want to address also the question you asked at the beginning of your series of questions, which is, will this have an impact on smaller banks, or will it be limited to the large banking organizations? It's very interesting because when the long-term debt requirement was first proposed, it was only, and it's currently only applicable to the GSIBs. Now, we warned, my colleagues and I warned other banks that, sometimes these requirements at the top have a tendency of coming to a theater near you, and now they're actually coming to a theater near the large regional banks. And so you really, if high standards are good, over time, they seem to be good for everybody, both big banks and small banks. And I think there is a risk that they will sort of be imposed downward. And also, there is this $100 billion level, right? There's a cliff effect. So if you're a smaller bank and the economy may actually encourage you and you want you to grow to a larger, to become more competitive, you will be deterred to do that, because if you cross the $100 billion threshold, all of a sudden you're subject to all these increased capital and long-term debt requirements.
Thank you, Mr. Chair. I see I'm out of time, and I yield back.
The gentleman's time has expired. The gentleman from Illinois, Mr. Caston, is recognized.
Thank you, Mr. Chairman. Thanks to everybody for being here. As a general matter, I don't think there's any problem with regulators saying we need to evaluate the risk of banks and make sure there's appropriate capital for the risk. I do have a concern when we're weighting things that are comparably risky in different ways. And I've been pretty consistent on this, specifically with respect to the tax equity provisions. That the rules say that if you're using tax equity for new market housing, it has one level of risk profile. If you're using it for energy investing, it has 4 times the risk. So essentially, banks would have to increase their capital holding by 4 times. So, Mr. Baer, just because I see you nodding your head, you want to just give us a quick understanding of why banks use tax equity and how that's used to deploy energy projects?
Yeah, actually, I would commend to anybody. Matt Levine, who's a journalist, wrote a terrific explanation of the whole bank financing of energy tax credits. And it's sort of interesting, sort of legally, how it works. And in effect, it's a loan, but it qualifies for equity tax credits. But there's no question that it's a helpful thing. But what it really gets down to, as sort of as an example of the proposal as a whole, what's the loss experience? The proposal includes no data on the loss experience for that business.
And I want to, and I don't want to avoid speculating, but I just wanted, the comment that this is loan-like, I think, is the material part. Because if I'm buying your depreciation, if I'm buying your interest payments on debt, if I'm buying your investment tax credit, I'm buying something that's a known commodity, it's a fixed coupon, right?
Yes.
Effectively, and it looks like a loan. So we're getting agreement on that. Earlier this week, the Bank of New York Mellon's CFO said that if the rule were to go ahead, it will severely reduce or even eliminate the capacity of banks to invest in renewable energy projects. Are you hearing that from other members of yours as well?
Yeah, I mean, I think actually some of our banks have commented to that effect. I mean, quadrupling the price of anything is going to affect the supply, and I don't think these are terrifically profitable.
Okay. And Mr. Kress, I know you were involved in a lot of the early work back in your Fed days. And I hope nobody asked me for my memory for what I was doing 10 years ago, but as you recall, was there a discussion in drafting up some of these early Basel rules when you're at the Fed about how this was going to affect clean energy markets, the risk experience of those clean energy tax credits?
So based on my experience at the Fed, this is a perfectly normal part of the notice and comment process, to put a proposal out, receive comment, and then make changes if necessary, consistent with safety and soundness. It happens all the time. It happened in the initial Basel III implementation. It happened in many other Dodd-Frank rules. So this is an indicator that notice and comment is working as intended, that the Administrative Procedures Act is being followed. And I just want to contextualize the tax equity issue, though very important, is such a very small part of the overall Basel III endgame package. Even if it were changed, it would not materially weaken the overall impetus of ensuring that we have strongly capitalized banks.
Yeah, no, I appreciate you saying that, because I do think that this is not an issue that dramatically changes the intent of Basel III. But it does dramatically change because, if I'm understanding you right, you all weren't thinking about this back in 2014, timeframe. We also didn't have the Inflation Reduction Act. And I would love to live in a world where we actually, if we decide that it's worth spending taxpayer money on something, we don't only afford that opportunity to people who have tax liability and good tax accountants. And that's a long conversation about why we consistently use the tax code to engineer our society. But as long as that remains true, let's not pass the biggest climate bill in the history of any government anywhere that is meaningfully changing the deployment of clean energy in this country, is meaningfully putting us on a trajectory to leave a better planet than the one we inherited from our parents for our kids, and then cut it off at the knees, because even though this is a small piece of the Basel III rules, it's a big deal for the clean energy industry that is basically making decisions to invest right now based on whether or not they can monetize the tax credits that we passed last term. So I hope we can fix it. I've led several letters with my colleagues to push it. Hope that notice and comment period is factored in. And thank you all for your time. Yield back.
It's always good when the gentleman from Illinois and I can find common ground. With that, I yield to my friend, the gentleman from Tennessee, Mr. Rose.
Thank you, Chairman Barr, for holding this hearing, and thank you to our witnesses for taking time to be with us today. The flawed Basel III proposal will have harmful impacts on consumers and small businesses. Simply put, the proposal's indiscriminate, one-size-fits-all approach undermines consumer lending and will result in less access, increased cost, and reduced innovation for consumer credit and small business loans. The impacts of the proposed rule will be disproportionately borne by regional, mid-sized U.S. banks and their customers, who are typically low-income consumers and those new to credit, as well as small businesses that invest in the creation and growth of jobs in local communities. By statute, these institutions are supposed to have their regulatory requirements appropriately tailored to their business model and risk levels. Mr. Gwynn, due to inflation, the ability of working-class Americans to finance essential purchases such as a house, car, or home improvements has become more costly and challenging. Wouldn't the disproportionate and unfounded capital constraints created by the Basel proposal further restrict access to credit, increase consumer credit prices, and exacerbate inflationary impacts for working Americans?
It certainly will. I mean, that just follows from basic economic analysis, given that a capital has an equivalent impact to a tax, and so it will reduce the supply and increase the cost. Now, if the capital levels were lower, you might say that cost is worth it because the benefits in terms of increased resiliency is worth it. But the agencies haven't put forward any evidence to say that the massive increases in capital have not been sufficient, and so I think they need to do that before the proposal is finalized with as substantial an increase in capital as the proposal would do.
Thank you, and I agree with your analysis. Tennessee prides itself in being a destination for foreign direct investment in the United States. We are home to more than 1,000 foreign-based businesses that have chosen to invest more than $47 billion in our economy in Tennessee and create more than 160,000 jobs. These foreign-based companies like Nissan, Bridgestone, Avigen, and many others rely on cross-border financing from global banks, including foreign banking organizations, or FBOs, operating in the U.S. to drive their expansion in Tennessee. I fear that the prudential regulatory proposals, including Basel III Endgame and long-term debt rule, risk making the U.S. a less attractive market for global banks, which largely finance foreign direct investment. Mr. Baer, how would the Basel III Endgame and long-term debt proposals adversely impact global banks' financing of foreign direct investment in the U.S.?
Sure. I mean, foreign banks now generally operate in the U.S. under two business models, a few with an overlap. Some are effectively just regional banks, certainly all the large Canadian banks and some of the European banks, and they will suffer just as American regional banks do under the credit provisions, op risk, and all of that. With regard to their market operations, and a lot of them operate either through subsidiaries or branches in the United States, they will certainly be seeing the extraordinarily high market risk charges that U.S. GSIBs in particular will be seeing. I think we've already seen a scaling back of European operations in the United States, partly because of the capital, but also they are facing an extraordinarily stringent examination regulatory regime where they're effectively having to duplicate their risk management in the U.S. versus abroad, even though it's a consolidated risk management process. So they are subject through what's known as the CUSO rules to a whole nother layer of examination, regulation, compliance burden in the United States, and generally don't get a lot of credit for that back home on the capital front as well as others.
Thank you. As the owner of a family farm, I know that the Basel III endgame could have devastating ramifications for the agriculture industry. Mr. Bosher, what might we expect to see in the ag industry if Basel III endgame is enacted?
I think liquidity would definitely dry up, both because a bank could operate as an intermediary or as a counterparty in those transactions. I think it's important for ag producers to be able to hedge interest rates or commodity prices. In particular, corn and soybean will be affected, since I believe the majority of futures and swaps that are used are by those two industries.
Thank you. I see my time is expiring, and I yield back, Mr. Chairman.
Gentleman yields. The gentleman from Texas, Mr. Green, is recognized.
Thank you, Mr. Chairman. I thank the ranking member as well, and I thank the witnesses for appearing. If you would kindly indulge me, I'd like to acquire some intelligence from each of you. I see that you are all very prominent personalities, well-educated. First question to all of you, and if you would kindly extend a hand into the air, if the answer is yes, I would greatly appreciate it. Do you have women working in the business you're in? If you do, raise your hand, please. Let the record reflect that all have raised their hands. And are there women in your business who are capable, competent, and qualified enough to appear here today? If so, raise your hand, please. Thank you. And is it fair to say that among you there is not one person who would identify as a woman? If this is true, raise your hand, please. Thank you. Let the record reflect that, once again, we have an all-male panel. Let the record reflect that my visual observation indicates to me that these are all white males. If you have identified yourself as something other than a white male, perhaps on some survey, census report, would you kindly extend a hand into the air? Let the record reflect that no hands have been extended into the air. I still believe that women are capable, competent, and qualified enough to sit on these panels. My friend, the chair, and I have discussed this. There are some times when we seem to do better than others. This is one of those days when we're not doing well. Let me move on to the questions at hand. Let's talk first about banks in this country. There are only approximately 67 banks in the country with more than $1 billion in assets. In fact, of the 4,500 banks that will be impacted by this rule, that could be impacted by this rule, only 37 will be impacted. Is this a true statement, is it Kress?
Correct, yes.
Is this true?
That's true.
All of what I said?
Correct.
And is it true that banks that are well capitalized lend money?
Absolutely.
Is it true that they lend more when they're well capitalized than when they're less capitalized?
That's correct.
And is it true that what we are proposing by way of a rule at Basel is going to benefit banks in that they will be able to lend more?
So I'm sure if you asked Mr. Baer, he would say that it doesn't benefit banks. I think what's important to note is capital is a choice, right? It's a choice about how we allocate the risk of bank failures and how we allocate the risk of financial crises. Strong capital rules force banks and bank shareholders and bank executives to internalize those costs. Weak capital rules externalize the costs of bank failures and bank crises on the rest of society. And we know when those costs are externalized that they hit the most vulnerable among us. Black and Hispanic workers were hit hard. In 2008, Black and Hispanic families lost 45% of their household wealth compared to 26% for white families. So bank capital is very much a social and racial justice issue.
And is it true that not one community bank will be impacted by this?
That's correct.
And I ask because there's a lot of consternation emanating from my friends across the aisle. They seem to think that this will wipe out the community banks.
This is 37 banks, all with more than $100 billion in assets.
Would you repeat that, please?
37 banks, all with more than $100 billion in assets.
Let me close with this. I was here in 2008 when Secretary Paulson came before this committee, indicating that there was some troubled waters ahead. And I was here when we voted on the $700 billion bailout package. We bailed the banks out. We imposed rules to capitalize them well, but now we see that there's a need to do more. I don't want to participate in another bailout. I'm not prognosticating. I'm not saying that this is a harbinger of things to come. But what I am saying is, it seems to me that rules that don't hurt banks, that cause them to be better capitalized, are not going to hurt those people who have their life savings in banks. Mr. Kress, would you quickly respond in the last 5-6 seconds?
Over the past 15 years, we've seen repeated public backstops of the banking system. This is a practice of privatizing gains and
The gentleman's
socializing
time has
losses.
expired.
Thank you,
Capital
Mr.
rules.
Chairman.
The gentleman's time has
Really
expired, and he
appreciate the
can
time.
submit the remaining answer for the record. Gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman, and thank you all for being here. Over the last year, our nation's federal banking agencies have been bombarding our financial system with excessive regulations and dangerous proposals like Basel III Endgame, long-term debt requirements, and climate risk management standards. It is alarming that our banking agencies are rolling out these types of proposals in a rush fashion without considering how these combined regulations and requirements might impact innovation, limit access to capital, and threaten economic stability. We've heard our federal regulators make false claims that these harmful onslaughts of regulatory proposals have a meaningful cost analysis. However, from what I see, many of the rules proposed since March of last year are hundreds to thousands of pages long, but all of these proposals lack an adequate quantitative analysis to ensure that the cost of these new rules would not negatively impact financial institutions, businesses, and I'm a small business owner in Texas, or the overall economy. There's no question that these burdensome rules will increase compliance costs to already struggling businesses. So, Mr. Bayer, did federal banking regulations analyze and estimate interactive effects of the 1,000-page Basel III Endgame proposal, long-term debt proposal, or the 1,500-page Community Reinvestment Act proposal?
Congressman, I mean, they made almost no effort to do that individually and certainly no effort to do that collectively. Actually, I'm glad you mentioned the long-term debt. I mean, for regional banks, that is an extraordinary requirement. They're being subject to the same requirement as GSIBs, even though it's for an entirely different purpose. For GSIBs, it's to facilitate a resolution where everything below stays open and operating. For regionals, which is somewhat understandable, to just have another layer of loss absorbency, but same requirement. Regional banks, it will be more expensive for them to issue debt than large banks, or the largest banks, which are constantly in the market. The market gives a liquidity premium, which the regional banks will not enjoy, so it'll cost more. And then also, I think the agencies, to your point on holistic review, simply did not understand the interplay between that rule and a liquidity rule called the liquidity coverage ratio, which for reasons I can explain to you over a beer, means that they're going to have to issue even more debt than projected. So that was, I think, a classic case of failing to understand the interplay of all these rules.
Thank you for that. One of the greatest concerns I have, along with many others, is that Basel III Endgame proposal will put America last and create disadvantages for American businesses and consumers. And by making U.S. standards more stringent than what was recommended to other international countries, U.S. regulators are picking winners, they're picking losers in the global market and forcing institutions that they regulate to end up being the losers. Now, bad actors like China will surely not be placing their financial system under such standards, so we must not allow our banks to not be able to compete on a global scale. So again, Mr. Bayer, could you elaborate on the competitive disadvantages that U.S. banks, businesses, and consumers will face due to this proposal? I mean, what's wrong with being American?
Congressman, I mean, obviously it's going to vary, I think, as I responded to the ranking member, business line by business line. I mean, obviously, for credit cards, U.S. banks don't compete with banks in France or other places. The biggest impact would be in financial markets and capital markets, where, again, U.S. banks have done terrifically well. I think, though, as you look at some of the risk weights here, and again, it's very technical, there are areas, particularly in dealing with the funds business, where U.S. banks could be looking at capital charges 3-4 times higher than overseas competitors, I think you'd see migration there. I think the GSIB surcharge continues to be an issue for the very largest banks. And I think the bigger concern isn't even competitiveness, it's just lack of capital markets liquidity. We've already seen inventory depth declining, even as the amount of bonds floating in the market has increased dramatically. So the ratio of market-making capacity to the need for market-making capacity is completely out of whack, and this would certainly worsen that. So yes, at the margin, certainly a competitiveness issue, but I think more an issue just about the resilience of U.S. capital markets.
Well, regulations just choke small businesses, no question about it. And I got limited time, so let me ask you a quick question, Mr. Bosher. Can you elaborate on how the Basel III proposal will impact small businesses' ability to grow and thrive in the economy? As I say, I'm a small business owner, so I'm interested in what you say.
I think it'll be a detrimental impact on small businesses because of the retail exposure provision in this proposal. On top of that, you have the operational risk provision in the proposal. And I think that, especially talking about community banks, I think community banks are actually affected in this because of the credit card interplay here, because a lot of them have to use larger issuers to issue their cards. And I'd just like to note that 82% of U.S. households have at least one credit card. So it is a large swath of Americans that will be affected.
Gentleman yields. The gentlewoman from Ohio, Ms. Beatty, is recognized.
Thank you, Mr. Chairman, and again, thank you to all of our witnesses. Professor Kress, I'd like to start by talking about Basel III capital requirement proposal. Let me just say I agree with your written testimony acknowledging the importance of strong capital requirements to avoid financial crises and to protect our economy. Like many of us and others of my colleagues have said, we remember the financial crises of 2008 as an elected official, as a small business going through that. But I also remember in 2009, under a new president, President Barack Obama, that Congress passed almost an $800 billion American Recovery and Reinvestment Act. Capital is unquestionably our first line of defense. And I want to make sure that I am on the record saying that. And I applaud the regulators' efforts to strengthen capital so that our financial system is safe and secure. We all know, whether it's small businesses or not, what happens when we go into a financial crisis. At the same time, I want to also be a champion of access to capital, particularly for underserved and minority communities. We just heard what can happen to small businesses. But we also know that historically, minority and underserved businesses have experienced unequal access to loans and other banking services. I think we can do both at the same time. We can increase capital reserves at large financial institutions while also promoting credit accessibility for LMI communities and communities of color. I'd like to now turn to small business credit and affordability. Professor Kress, does the Basel III proposal decrease risk weights for all small businesses or just a subset?
So there's a different treatment in the credit risk framework depending on whether the company is publicly traded. For non-publicly traded small businesses, the risk weight is 100%, which is the same as the risk weight under the existing capital rules. So the credit risk framework would not change for non-publicly traded businesses. It would drop to 65% from 100% for publicly traded businesses.
What was the reasoning behind the different risk rates for these types of businesses? And what changes can we make in the final rule to achieve the same goal without disadvantaging small businesses?
So I will note that U.S. regulators are under statutory constraints. In Section 939A of Dodd-Frank, Congress told the regulators that they cannot use credit ratings to set risk weights for businesses, as is done internationally by most other countries. So this attempt by regulators is an attempt to use a standardized, non-credit ratings-based methodology to assess riskiness. As with green energy tax credits and residential mortgages, this is an area where the regulators have received public comment in another example of the public comment process working, and they've indicated an openness to considering alternatives.
Let me continue with this note. Some have claimed that Basel III Endgame proposal runs afoul of the Administrative Procedures Act. Can you set the record straight for us and explain the steps that regulators took prior to issuing the proposal to conduct a thorough analysis and to meet all of the standards and requirements?
Thank you for this question, because I feel like I've been living in an alternate universe, hearing the descriptions of how this rule allegedly runs afoul of administrative law. The quantitative impact analysis done in the Basel III Endgame proposal is more substantial than in any banking rule I've witnessed. The banking agencies have already conducted a QIS. That's why we know that the risk-weighted assets for market risk will increase more than double the increase in lending-related risk-weighted assets. That's how we know that the capital requirements for the largest GSIBs will increase almost 3 times as much as the capital requirements for mid-sized banks. The proposal has been put out for comment for 173 days already. Regulators have promised to do another quantitative impact study, release that study for public comment. This is way more than was done, for example, in the initial implementation of the Basel III rules when I was at the Federal Reserve. And it's a quantum leap over what was done to comply with administrative law with the deregulatory rules established under the Trump administration. If you look back at the tailoring rule, for example, there was no effort to quantify impacts on the economy other than a conclusory statement that it would not materially impact.
The gentlewoman's time has expired.
We know now that that's false.
Thank you so much.
The
Thank you, Mr.
gentlewoman's time
Chairman.
has expired. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized.
Thank you, Mr. Chairman. Before I get into the questions that I had, Professor Kress, you mentioned earlier that the Basel proposal would only apply to a small group of 37 banks. I just wanted to get, Mr. Baer, your comment on that number, and could you respond to that? Do you think that's accurate or close?
Sure, Congressman. It's correct, but perhaps a trifle misleading, as those banks hold, I think, approximately 85% of U.S. banking assets.
Gotcha. Thank you for verifying that. I've been pleased to see that some of my colleagues on the other side sounds like some of them are seeing some at least significant issues or problems with the implementation of the proposal. However, rather than going back to kind of the initial everything on the initial drawing board, some of my colleagues on the other side are pushing only for this narrow carve out from increased capital requirements for green energy tax credits from the Inflation Reduction Act. So, Mr. Beshear, if such a carve-out is granted to address only one of the many problems in the regulator's proposal, while much of it would still be intact, what message would that send, not just on the independence of the Federal Reserve, but to families who may have more difficulty getting a mortgage, or, as said before, small businesses who would see the reduction in access to credit?
I think it would send a bad message because there are so many provisions in this proposal that contravene S2155 and apply uniform regulation over categories 1 through 4. One of them being the tax equity piece, but then again with supplementary leverage ratio, AOCI for AFS securities, among others. I think that it has to be, and the fact that we do not have a detailed cost-benefit analysis, economic analysis, I think it warrants reconsideration altogether.
Very good. Despite the unnecessarily drawn-out process that has kind of characterized bank mergers under this administration so far, yesterday, Acting Comptroller Sue announced changes to the merger process that would make the process slower and probably less transparent. This follows DOJ's plan to update guidelines on banking mergers to provide more robust scrutiny, and Vice Chair Barr's expressed desire to assess how the Federal Reserve platform performs analysis on bank mergers. So if you believe antitrust analysis should follow the rule of law and not the individual views of those who at any particular point in time head the relevant agencies, I'm concerned any change in that analysis that would depart from long existing and widely accepted standards may not reflect actual changes in the competitive environment. Further, the capital proposal from the Fed and other financial regulators, on top of the other recent regulatory proposals, is bound to lead to consolidation to overcome the compliance burden of this rulemaking. To Mr. Gein, if the Biden administration insists on throwing up obstacles to bank mergers while sharply increasing the regulatory burden on banks, is it time for Congress to step in and ensure there is a transparent, defined timeline for approving or denying a merger?
Thank you very much, Congressman. So it's interesting because I actually think that the administration's policy that disfavors bank mergers is at war with its policy in Basel III Endgame, because the Basel III Endgame has the biggest economic impact on the regional banks, and that will actually give them a powerful economic incentive to become much larger. Otherwise, they become uncompetitive. And so if you then say, well, you can't merge, there's a risk that they will become weaker and weaker financially, and that will cause a problem for the system. And basically, that will increase the risk of failure in forced mergers and FDIC receivership. So I guess in answer to your question, I think it would actually be useful for Congress to propose a bill to reform and make more rational, more predictable, more transparent the bank merger approval process.
Thank you. I'm going to try and sneak in one more question here real quick. Small businesses are increasingly turning to credit cards as a key source of funding. Research shows 30% of small businesses have used credit cards as their primary source of funding. Another 22% relied on a loan or line of credit. Mr. Baer, at a time when small businesses are facing tighter monetary policies, particularly when it comes to securing loans from traditional and non-traditional lenders, would revised bank capital standards under Basel Endgame further limit small business credit?
Absolutely, Congressman. I mean, first, because they do not qualify for a favorable risk weight because they don't have listed securities, even though our research, which we published, and I would commend to you, shows that for a bank that rates a business investment grade internally, whether that company has listed securities or not is entirely non-probative of default and loss given default. There's no justification in the proposal for it, and we've demonstrated it's entirely spurious.
Gentleman's time has expired. The gentlewoman from California, the ranking member of the committee, Ms. Waters, is recognized.
Thank you so very much for this hearing that we're doing today. I am a bit irritated here because it seems as if we have forgotten in such a short period of time what has happened in this country as it relates to this struggle to increase more capital in our largest banks. I'd like to just raise a question here about what took place with our banks. Last year, we saw the second, third, and fourth largest bank failures in the United States history. It started when Silicon Valley Bank sold its securities at a loss. Is that correct?
Correct, Ranking Member.
Investors and customers lost confidence in Silicon Valley Bank and pulled their money, resulting in the biggest bank run. Is that correct?
Correct.
We later saw that Silicon Valley Bank was exempt from certain bank capital requirements pursuant to a Trump regulatory rollback when they should have held 2% more capital for the security portfolio that they sold at a loss. Is that correct?
That's correct, and I would note that that regulatory rollback was done with no impact analysis.
This Basel III Endgame rule could fix that problem. Is that correct?
That is what is proposed.
So in 2018, Trump signed 2155 into law to deregulate large regional banks, and Trump's regulators, that law was a blank check to roll back all kind of requirements on banks like Silicon Valley Bank. Is that correct?
Correct.
They claimed this deregulation would not undermine financial stability, and Silicon Valley Bank prove that was a lie. Is that correct?
Absolutely.
And so now we have all of our regulatory agencies working together, FDIC, OCC, the Federal Reserve, all saying this rule is very important, that because of Basel III endgame, that we should raise that capital so that we will not again witness what we witnessed with the failure of not only Silicon Valley Bank, but it was Signature Bank and First Republic Bank. Three of these banks that had a run on them, and it all had to do with a lack of capital when the run took place, and they didn't have the capital to make sure that they took care of their depositors. Is that right? And
Yes, ma'am.
so, with the federal banking regulators jointly issuing a proposal to strengthen capital requirements for the biggest banks known as Basel III Endgame, shouldn't that be what the members of Congress are doing in order to avoid the catastrophe that took place with Silicon Valley Bank and Signature Bank and First Republic? Isn't that what we should be doing? This proposal will help prevent future financial crisis like the 2008 financial crisis, when Lehman Brothers and other large financial institutions failed, costing the U.S. economy $22 trillion and resulting in massive taxpayer bailouts. We bailed them out, and we said we would never do that to our taxpayers again. And the way to do that is to ensure that they have the capital that is needed to avoid what happened with Lehman and Silicon Valley Bank and Signature Bank and First Republic Bank. Is that correct?
Yes, ma'am.
The Dodd-Frank Act required the largest banks to hold more capital, but Trump-era deregulation reversed much of that, causing the failures of Silicon Valley Bank, Signature Bank again, and First Republic Bank, the three of the largest bank failures in United States history. Capital is not locked away. Rather, it is safe funding that banks can redeploy, which is why better capitalized banks lend more, not less, to consumers in good times and bad. Is that correct? How soon we forget. How soon we want to run away from 2155 when it became apparent what had happened when deregulation took place. And now we have others who wish to ignore what our regulators are saying and not go along with Basel III Endgame that says we must have 2% more capital. I don't understand it. Do you?
No, ma'am.
Thank you. I yield back.
Gentlewoman yields back. The gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman. I want to thank our witnesses for being here today. And since our ranking member mentioned the failure of the Silicon Valley Bank, and I'm also from California, just to be clear, I would like to state for the record that SVB's failure was about liquidity, not capital. And I think it also had to do with the mismanagement of the banks and the failure of the regulators. But I want to start by coming back to the focus of our hearing and make a couple of observations. One, I am deeply concerned that the Basel III Endgame and the other proposals will make credit more expensive for small businesses, and it will reduce mortgage lending to low to moderate income households and put our banks at a competitive disadvantage abroad. I'm also concerned that the current proposal as written does not enjoy broad consensus from the Federal Reserve Board. It's been reported that certain European countries want carve-outs on their own Basel III Endgame proposals to protect their banks from the increased cost of higher capital requirements. And in Asia, 3 of the top 10 companies in the world are giant-sized, state-owned Chinese banks that, to my knowledge, aren't planning to implement the Basel framework anytime soon. Question to you, Mr. Baer. One of the Basel Committee on Banking Supervision's core mission is to harmonize regulatory standards to bring other international jurisdictions up to the US regulatory standards. So in your view, what will happen to the competitiveness of our banking industry if US capital standards are not harmonized with other international jurisdictions?
Yes, I mean, it's a great point, Congresswoman. Actually, at the time that the 27 agreement on Basel was announced, they said they did not expect an increase in capital requirements. They published a quantitative impact study showing that it would not result in an increase in capital requirements. Around the world, you see that basically being the trend. The Bank of England has implemented with a 3% increase in capital requirements, compared to, I think, the initial estimate from the U.S. regulators was 16%. I think when they're done with the QIS, it's going to be closer to 20. So clearly, if the desire is consistency, we are failing utterly. We have a U.S.-only GSIB surcharge methodology, which is roughly double the global standard. We have a U.S.-only stress test and stress capital charge, which again largely duplicates the op risk and market risk charges in Basel. So it just goes on. And as noted, even for small businesses, although they don't directly compete, but just as a measure of rationality, both the UK and the EU have abandoned the securities listing requirement.
Yeah, so Mr. Baer, if the financial regulatory agencies move forward with the Basel III Endgame proposal, would you say that credit will be more expensive for our small businesses, manufacturers, and families when compared to other countries in the US and Asia?
Absolutely, Congresswoman. I mean, the capital charge for a loan to a U.S. small business would be significantly higher than for a small business.
You know, our country is the envy of the world because we have more banks than anywhere in the world. In fact, more than 4,000 banks provide credit to most corners of our society. The question to you, Mr. Gwynn, in your testimony, you state that under the proposals, large regional banks will have strong economic incentive to consolidate to better compete against U.S. GSIBs. So can you elaborate on how the proposals will push banks to consolidate? And can you also tell the committee how greater consolidation will impact credit for small businesses and households?
Yes, okay, so the reason there's a disproportionate impact on the regional banks is they are subject to the increase in capital by the Basel III Endgame, and a rule that used to only apply to or currently only applies to the GSIBs will now be extended to them, where they're now going to be subject to subordinated long-term debt requirement. Subordinated debt is just a different name for an additional capital requirement. So when you add those two together, basically they will now be subject to nearly 2 times the amount of capital that they're currently subject to. That will be very expensive for them. They're smaller than the GSIBs. They will feel a need to have larger scale to be able to spread those costs over a larger base. And so they will have a powerful incentive to merge and consolidate. And also, if I do think that it's a sort of separate issue on small businesses. I think that the real issue for the small businesses is, I think the regional banks will continue lending to small and medium-sized businesses, which they focused on, but the risk weights will now disincentivize that because they will say, well, I only am charged a capital equal to 65% of a loan that I make to a large business that is publicly listed, but I have to have 100% charge for a smaller business.
The gentlelady's time has expired. The gentleman from New York, Mr. Meeks, is recognized.
Thank you, Mr. Chairman and Ranking Member Foster. Let me just say, while I think many of us feel like we have had ample opportunities to discuss the Basel III Endgame implementation proposal in this committee, I really do appreciate having a forum to look at the proposal and rulemaking process to see what improvements could be made. And now that the comment period has ended for the Basel implementation proposal, I want to express how much I have valued being able to weigh in with the regulators about concerns that I and many of my colleagues have about unintended consequences of the proposal. In my meetings with the regulators, I've actually found a genuine willingness to discuss how the proposal could be improved to address the issues that have been raised. I also believe that they share in our broader goals of addressing historical disparities in access to home ownership, which is a primary function of mine, of having access to home ownership, which helps close a wealth gap, particularly in communities of color, as well as in credit scores and credit. And I believe in the important role that CDFIs and MDIs play in our communities, in our ecosystem. And I want to make sure that they are also taken care of and not become victims of something that was unintended. So my hope is that they will take into account the wide variety of comments received in order to have a comprehensive view of the various changes that need to be made. Now, I've been here long enough. In fact, I was sitting in this committee during the 2008 financial crisis, and I witnessed the ensuing devastation that it caused in communities across this country. And I never want to see something like that happen ever again. I believe that the safety and soundness of our banking system is paramount, as evidenced as recently as just this past March. I never want there to be confusion that raising concerns about potential impacts means that I don't support and understand the regulators' intent. Their intent is to do the right thing, and we're trying to make sure, I'm trying to make sure that the intent is met and we don't have any unintended consequences, which is the reason why I thought it was very important for me and others to ask the question that we ask. But I'll ask Dr. Kress, in your testimony, you acknowledged that high loan-to-value residential mortgages are an area where adjustments to the proposal may be appropriate. And data shows that LMI borrowers and LMI communities and Black and Hispanic borrowers are disproportionately represented in the highest LTV categories. So do you believe that, as written, the proposal will translate into higher costs for borrowers in the highest LTV categories? And could you identify the targeted changes you referenced in this area?
Thank you, Congressman, and I'm heartened to hear that you've had productive conversations with the regulators. That is an example of the notice and comment process working as intended, having those productive conversations in contrast to the threats to sue, to block the rule that we're hearing from the banking sector. As I noted earlier, the regulators laid out 3 possibilities for how to address residential mortgage risk weights in the proposal. I know that they have received comments on all of them, and they've indicated openness to perhaps changing their prioritization of those options. So I'm sure those are conversations that they're having within the building, and I know that they share your goal of protecting the safety and soundness of the banking system while ensuring access to credit.
Thank you. A little time out, but Mr. Baer, I wonder if you could speak to how those various regulatory proposals could interact with one another and what it could ultimately mean for the consumer.
Sure, Congressman. I mean, clearly that's one of the concerns here is that, even within the Basel proposal, the overlay between operational risk and credit and risk has not been considered. We have not even talked about securitization today, where there are punitive charges which will affect the ability to make mortgage, auto, credit card loans, including to low and moderate income people, and distribute that risk. The charges here are roughly double the current, whereas around the world it's actually...
Gentleman's time has expired. The gentleman from Florida, Mr. Donalds, is recognized.
Thank you, Chairman. Gentlemen, thanks for coming here today. Mr. Gwynn, Vice Chair Barr notes that the U.S. banking system became significantly more capitalized following the great financial crisis, which is true. With that, he's trying to sell the idea that greater capitalization, the better capitalized U.S. banks experience lower funding costs, are more profitable, and have gained more market shares in global markets for financial products relative to their global competitors. Are you aware of any study that has shown a causal connection between U.S. banks' capitalization and their global competitiveness?
I'm not aware of any such study at all, Congressman.
So what's Vice Chairman Barr talking about?
So I think he's speculating. Now, he said he did a holistic review of capital requirements, but he's yet to release what the data and what the conclusions are. Maybe he will actually release those after he has the data from the banks that I guess they're now looking at. I hope that they do, because there does need to be a lot more justification for why capital needs to be raised. As you know, as discussed earlier in this hearing, it's a trade-off. You can have perfectly safe banks, but no lending to and other banking services, or you can have unsafe banks and a lot of lending and other banking services. What we're trying to do is we're trying to hit the right balance. And the question is, we've been increasing capital now for a number of years. Are we at that right balance, or do we need to have still more capital? It's not cost-free, despite what some people say. And in our view, until someone shows that the benefits of that increased capital is higher than the extra cost, then I don't think that this proposal should go forward.
Well, let me ask you this question. I think it was raised earlier in this hearing that U.S. banks are still competitive compared to their international counterparts, even with the extended regulatory and capital requirements that we've enacted in the United States since 2008. Different way of looking at that. Are U.S. banks more competitive to other capital, other ways of raising capital, i.e. private equity, venture cap funds, other private endeavors that actually don't have to deal with Basel requirements or have to deal with the burden of the regulatory system in the United States?
Yes, that's a very good question. And in fact, one of the consequences of this will be to continue the trend of having non-bank financial institutions have a greater and greater share of the credit provided in the U.S. economy. So in 1980, that was about 30%. It's now close to 60%. And as you increase...
Mr. Gwynn, I don't want to cut you off, but we're in a congressional hearing. Sometimes we have to restate these things.
No problem.
In 1980, private access to credit, meaning not through the banking system, was 30%. It is now 60%. I mean, Mr. Baer, do you agree with this assessment that the more we do this, it's actually going to continue to shrink the regulated banking system in the United States because people are smart and they're just going to say, why am I doing business this way? I'll just do it another way and get around the federal government. Because, and I'll add before you answer that, Mr. Baer, my problem with the government overall is that the government has become omnipotent busybodies who think they know everything, and they don't. Silicon Valley Bank is a testament to that. Mr. Baer.
Sometimes I think of myself as an omnipotent busybody, but I won't take that personally. No, I mean, certainly we have seen in certain asset classes, an incredible rise in private equity, private debt, certainly non-bank mortgage. And, some would say, oh, that's a problem because they're not regulated like banks. I mean, that may be a problem. I think the larger problem, and we've seen this, is that they are not durable lenders like banks. The reason we have banks is because they take in deposits, which are relatively stable funding. They have access to a discount window, which is emergency funding, and that lets them lend money cheaper, and it lets them lend money under stress. And so the question is, regulation aside, what's going to happen under stress with these lenders when they don't have any real stable funding to do that? And I think what we're going to see, and we've already seen in capital markets, is well, it's actually the government that steps in. We saw that in the Treasury market, which forever had been advertised as the most liquid market in the world, and we had the Fed intervene as the market maker of last resort, a phrase that didn't exist pretty long ago, in both 2019 and 2020, and begin trading the bonds. So I think the drift from banks is a concern, initially because of cost and stability, but then also because of government.
Mr. Baer, well, real quick, Chairman, I know I got 15 seconds. Mr. Kress, thank you for being here. In your opening statement, you essentially said that, and I'm paraphrasing, that because of the fact that the United States government has stepped into the position of bailing out banks, it is also the position of the United States government to make sure that banks are appropriately capitalized so we don't have to go into that business again. Is that correct?
That's correct.
Mr. Chairman, if you indulge me.
Jed,
you indulge me real quick, Mr. Chairman?
we can have him submit the answer for the record.
I'll just pose this question to the witness. The question is this: if that's the premise, then why don't we stop bailing out banks? And why don't we actually look at the regulatory system itself so banks aren't in a position
Gentleman's time
to
has
be stressed?
expired.
I yield.
Submit that for the record. Gentleman yields back. We now go to the gentlewoman from Texas, Ms. De La Cruz.
Thank you. Thank you, Mr. Chairman, for holding this important hearing, and thank you to the witnesses for appearing before us today. Mr. Baer, this question is for you. Many people in my district rely on regional banks. Have regulators provided an analysis on what Basel III's regional bank customer impact will be?
Congresswoman, yeah, that is one of the failings of the proposal. There's very little data analysis, very little cost benefit.
So the answer is no.
And no.
Now, Mr. Bear, have the regulators provided analysis of the impact that the effective repeal of S 2155 will have on regional banks and the customers that rely on them?
No, Congresswoman.
And Mr. Bear, have the regulators provided analysis for the impact on rural areas if regional banks aren't able to lend because they don't want to cross the 100 billion mark and become subject to Basel III?
Not that I'm aware of.
And Mr. Bear, in October, I sent a letter with other members of this committee to the regulators, and we highlighted the impact Basel III would have on our farmers and our ranchers. Have the regulators provided an analysis for what the impact will be to our farming and ranching community?
No, and I would add that that's not just lending. Securities markets, a lot of farmers and ranchers want to hedge their risks. There are punitive capital charges around end users' use of derivative products. So there are any number of impacts on folks like that that are not quantified.
So what I've heard is no to every question that I have given, that there has been no analysis made, and it's clear a comprehensive benefit analysis hasn't been done for Basel III Endgame. So, Mr. Bear, could you share with me, how should the regulators move forward in light of this?
I'm glad you asked. I mean, we talked earlier about, and I think Mr. Kress mentioned that they did a quantitative impact study. They said how much it's going to go up. I think they were off a little bit, but even taking that, the question, though, isn't how much did it go up? The question is, why did it go up? And is the benefit of it going up worth the cost of it going up? So they did a little bit on the first question. They're going to do a little bit more, but we have not begun to answer the second and third question. The second question is all around what are the relative risks of these assets? I'd also just object to the notion that the banking industry is putting out disinformation and threatening to sue. My institute has probably published 24 academic quality research notes on every aspect of this proposal, from market risk to credit risk to operational risk, published by PhD economists, subject to comment by anybody who wants to comment. We've filed probably a total of 200 pages of comment letters on this proposal with rigorous data, rigorous analysis. We've not heard any challenge from those who instead would prefer ad hominems. This is very serious business. It has real impacts for the U.S. economy, and the fact that there's no data analysis behind this is a real problem.
Well, what I'm hearing is that putting a rule forward where there has not been any kind of analysis, no cost-benefit analysis, when all we're hearing from communities, from securities communities to farming and ranching and rural communities like mine, South Texans will be affected if this rule goes into place. And the repercussion of it could be crippling local economies like mine that are rural and that are largely Hispanic. So thank you so much, Mr. Bear. I yield back.
Gentlewoman yields back. We now recognize the gentleman from Tennessee, Mr. Ogles, for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here. You know, one of my colleagues posed a question, you know, considering, as my colleague also pointed out, little data or analysis has been done. Should this proposal be withdrawn as it stands, Mr. Bear?
Yeah, I think certainly parts of it, although then at that point maybe you do the whole thing. But yeah, I mean, there are clearly aspects here where they are way off the mark. And to the extent that they adjust when they see the new impacts, it's not just the banking industry that should have the right to comment on that. I mean, one virtuous thing here, and I think the Congressman was sort of hinting at this, is it's not the banking industry who's filing all these comment letters. It's civil rights groups, community groups, end users and the buy side and capital markets, small business groups. So folks are getting the message that this isn't a banking issue. This is an American economic issue. And I think if there are going to be major changes made to the proposal, it's not just the banks that have the right to comment on that, but everybody else.
Mr. Basher.
I think the lack of economic analysis and the fact that this is clearly an abuse of their discretionary authority warrants withdrawal of the rule in its entirety. I think they do not have unbridled authority, and I think that this rule is just an example of we just want to do what we want to do. without any consultation with Congress. And I think my goal here is I want the elected representatives to make these determinations. I do not want unelected bureaucrats to be making what CFRs are effectively law. And so I think that this needs to be coming from you all ultimately.
Yeah, no, you make an important point out there. Mr. Bayer, on January 12th, your organization, along with other industry organizations, filed a comment letter on Basel III endgame proposal. In the letter, your organization noted there were significant violations of the Administrative Procedure Act as it relates to the proposal. Can you touch on that? Because it kind of gets back to where should the authority lie? So for example, I've got the Stop Basel Endgame Act that essentially just pulls it back. I mean, when you look at a set of proposals that's trying to make us, quite frankly, more like Europe, when we have a different type of banking system that's much more resilient than the rigidity that you see in Europe and the lack of free market influences that you see from Russia and China, both of which had input into the Basel Endgame. Why would we want to comply with their ideas when we have an entirely different banking system based off of a different free market model and make ourselves less competitive? But I'll stop there and let you answer the question.
Yeah, I may quibble with you a little bit there. I mean, I do think that there is virtue in having common standards across the nations with which we compete in banking and finance. And actually, I mean, one of the ironies here is if they had proposed something more like what has been adopted as Basel in Europe and the UK, I don't think there would be nearly as much concerns. It's all the add-ons. It's the additional charges for mortgage, small business.
That's right. And so I'll claim my time. I mean, so that's the issue that I see here is that it's not the same. And again, we can maybe over a cup of coffee we can quibble back and forth. I would argue that our banking system is much different than that of Europe's, and that there is more free market component. Now the problem is when you look at the regulatory regime, when you look at the bank failures of New York and California, that was management failure. That was a regime that didn't do its job. There should have been not just red flags, but there should have been flares going off that these banks were in trouble. And so again, this is a failure. And so now you have this not just reaction, but overreaction in the marketplace of putting more layers and more burdens. Look, I come from a southern middle Tennessee, so a lot of my district is rural and suburban. And when I see more regulations being layered on top of banks and credit unions, that is affecting the access to capital. That someone who was suddenly eligible for a $300,000 or $350,000 mortgage, they're not qualified for that anymore. That small HVAC company that requires them that line of credit to make payroll in the lean months, suddenly that's being lowered or not renewed. And so it's having an impact on my economies, all because you have an administration that, whether it's the CFPB, the Fed, you name it, any alphabet agency, they've gone too far, too fast, and they've done so without any quantitative analysis to back up their presumptions. And you and I become the guinea pigs on their theories on how this is great for America, when I would say when you look at their failed policies, whether it's immigration, whether you look at the terrorists that are come across this country, and I sure as heck don't trust them with the economy or the banking system, enough is enough, and it's time for Congress to take back its authority to truly control the purse and put this administration in its place. With that, Mr. Chairman, I yield back.
Gentleman yields back. We now recognize the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman. The Basel III Endgame proposal has generated the lion's share of attention throughout this administration's regulatory onslaught, but the federal financial regulators have put forward many other proposals related to bank capital requirements, including proposals for long-term debt requirements. In November, I, along with Chairman Barr and many other members of this committee, authored a letter expressing concerns with the long-term debt proposal and asked for a comment period extension. The extension was granted, but many of the underlying concerns still persist. Due to these underlying concerns, it is my belief that this proposal is far too prescriptive and should be withdrawn. However, we must accept the reality of the situation and work to get the proposal to the best place possible for Americans. This includes doing away with the regulators' one-size-fits-none approach and prioritizing tailoring for banks based on their risk profiles and size. Mr. Baer, how can federal regulators tweak or, let's say, recalibrate the LTD proposal to reduce the potential for negative consequences on the banking sector?
Yeah, Congressman, thank you for that question. I mean, I think on the long-term debt requirement, the solution there is actually relatively simple compared to Basel. It's simply to reduce the calibration. I mean, instead of 6%, it should be a fraction of that. Again, as I noted earlier, it's for a different purpose. For regional banks, it's basically to add another layer of loss absorbency because the regional bank has almost all of its assets in the bank and will be resolved by the FDIC. The reason for that requirement for the GSIBs is entirely different. There's a large broker-dealer. It's going to be resolved at the holding company level through a bankruptcy or a Title II, and there you need to recapitalize at the holdco, and you need to keep the subsidiaries open and operating. Again, the costs to the regionals are disproportionate. They don't have as great access to liquidity as the large banks because they simply don't issue as much debt. So they will have to issue more. If it were 6, they would have to probably issue 7, 8, 9% because they need to be in the market all the time. So and then as I noted earlier, and it's quite complex, it's not easy to just substitute a deposit from the holdco to the bank since there's a separate bank level requirement with more long-term debt because then the holding company has to go out and issue more. So I think without really realizing the repercussions, they've imposed the requirement for regionals both at the holdco and the bank level, something not done for GSIBs, again, because that's a holding company strategy. But I think they thought that was a relatively simple matter. In fact, it's fantastically expensive to the regional banks.
Sure, thank you for that. Given the extremely prescriptive manner in which the proposal seeks to distribute the debt, there's a real risk that the issuance of significant amounts of bank debt without regard for macroeconomic or market conditions in a compressed time frame will potentially result in decreased appetite for these assets. As such, the value of this debt could be severely negatively impacted. Considering the short 3-year compliance runway, what risks are presented when such an artificial amount of LTD floods the market, and how will banks have to react to mitigate that risk?
Yes, exactly. As noted, they are not volume issuers, so that will be more difficult. There's also a sort of a technical issue with the proposal that we hope will be corrected where there's a $400,000 minimum issuance requirement. The goal there was, well, let's make sure that this debt isn't sold to, mom and pop investors. It turns out even in institutional markets, the debt is usually significantly smaller increments than $400,000, $50,000, $100,000. So saying it has to be $400,000 and more would not just prevent retail customers from buying it. It would prevent a lot of institutional customers from buying it. And of course, retail customers, mom and pop, widows and orphans, whatever you want to call it, they're not going to be buying long-term debt from a regional bank in $50,000 increments. So that needs to come down if it's going to be feasible for them to issue this debt.
That was actually my next question. How do you think federal regulators came to this number, $400,000? Seems pulled out of thin air.
I don't know how they came to that. I know in speaking to a lot of bankers and investment bankers that it is unworkable. I also think, I give them credit. Maybe this is an example, as Mr. Kress notes, of the comment process working. I do think that sanity will win out here.
Thank you. Our banks are capitalized at the highest levels in our nation's history. Time and time again, regulators are touting the health of our banking systems, yet they're trying to implement policies that will unnecessarily restrict access to capital and make life in President Biden's economy even more of a challenge. Thank you to the witnesses for their expertise today. I yield the rest of my time. Thank you.
Gentleman yields back. We now recognize the gentleman from South Carolina, Mr. Norman, for 5 minutes.
I'm in the real estate business. Been in housing for a long time. The Basel III, I guess the end game is the best way I can describe it, is going to negatively affect the housing market. And some of the rules that have been put in place, like the mortgage, the risk-based assignments of mortgages, disallowing banks to use private insurance to lower the risk for those who put less down payments into a home, is going to dramatically affect the banks. How do y'all see this? Mr. Bear, I'll ask you.
Again, it just comes down for me to what's the data and the evidence here. And, as I think I mentioned earlier in the hearing, if you think about mortgages, the current risk weight's 50%, the advanced approaches, which is the better measure, is 25%, Basel is effectively 25%, and we're looking here at 95% if it's on balance sheet and even more if it's sold to a GSE. That's really hard to understand. And the other, this rule is so complex, and it's why it's so disappointing there wasn't a more analytical rigor applied to it. Commercial real estate actually does well under this proposal. People don't realize that. I think they actually do better than the current standardized. But you've got to really take it asset by asset and ask yourself the hard questions about, okay, what's the loss experience and what's the appropriate charge for this? But that's really the work that wasn't done here.
And the analytical firepower is there. Why aren't they using that? I mean, it doesn't take a rocket scientist to figure this out.
Yeah, I mean, it's not just the analytical firepower, but there's incredible amounts of data on this that the banking agencies have through their own call reports, but also exists in the private market. We've tapped operational risk loss data, which they did not use, which is freely available. They didn't cite their own operational risk loss data. So it's very difficult to understand. I mean, I think some of this was simply, as I think we've discussed a few times, well, we'll just take whatever we agreed to in Basel as a compromise with the rest of the world. But again, what's harder to understand is why all of that has now been added to with surcharges and with, again, with no recognition that there is going on in the background a Fed stress test that nobody else in the world is running, and which is effectively double counting a lot of these risks.
Well, so goes housing, so goes the economy. And with all these regulations and everything else this administration is doing to train wreck this country is astounding. Does anybody else want to comment on this?
I would just say that with regard to the mortgage piece, ultimately what it comes down to is it's arbitrary. The new risk weight is arbitrary. And I think that, again, that just plays into the fact that the economic analysis has not been properly done here. There's been no disclosure, there's been no communication, and we need to get to the bottom of it.
Congressman, I would ask my fellow panelists to identify any banking rules in the past 2 decades that would meet their standards for the types of analysis that ought to be done here. The Basel III Endgame rule has already gone through one set of quantitative impact assessments. The agencies put it out in the proposed rule. That's far more than was done in Dodd-Frank 15 years ago, and that is quantum leaps more than what was done under the Trump administration while the Trump administration was deregulating. They're trying to establish a high standard that is not found anywhere in the law in an effort to protect bank share prices, share buybacks, and executive compensation.
Would you not admit this is a different time and it's a different era? I'm in South Carolina. People are moving there. But with the energy policies, this administration, just to give you an example of the energy policies, that is train wrecking my industry in South Carolina with people coming there. What you're just saying makes no sense.
I think 2 things have changed. One is a collective amnesia that Ranking Member Waters pointed out. We forget the consequences of financial crises. And 2, we have seen a movement in the judiciary to put up new barriers to administrative rulemaking. The banking sector appears to be taking advantage of that, again, to protect share prices and executive compensation.
Well, it's not protecting the economy. It's not protecting an industry that is the bellwether for the economy. And it's really a sad day that this is taking place. You can make all the, I guess, excuses, but the results will be what the results will be, and it will not be pleasant. I yield back.
Gentleman yields back. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is adjourned.